All right, let's talk about investment funds. You hear these terms thrown around all the time: mutual funds, index funds, ETFs. But what do they actually mean? We're going to break it all down, figure out how they work, and most importantly, what it means for your money. Let's get right into it. When you really get down to it, all of investing boils down to one simple, fundamental choice. It's a choice that pretty much shapes your entire strategy and, well, your final results. The big question is this: are you trying to be a stock market genius, or are you just happy to own the whole thing? And these are the two basic philosophies right here. On one side, you have the people trying to pick the winners, the active approach. They're trying to outsmart everyone else. And on the other side, you've got the passive approach, which is basically saying, hey, why try to find the needle in the haystack? Just buy the whole haystack. This one choice is the key to understanding every fund we're about to look at. So let's start with the most simple, most straightforward option out there, the one that's become the go-to default for millions of investors: the index fund. The whole point of an index fund isn't to be a hero. It's not trying to hit home runs. Its only job is to match the market. So if you buy an S&P 500 index fund, you're not just betting on one company. Nope. You're buying a tiny little slice of 500 of the biggest companies in America. We're talking Apple, Microsoft, Amazon, the whole lot. If the market goes up, you go up. It really is that simple. And hey, don't just take my word for it. This comes from Warren Buffett, maybe the greatest investor of all time. He recommends this exact strategy for most people. So when the Oracle of Omaha tells you to keep it simple, it's probably a good idea to listen. And notice he says low cost. That's absolutely crucial. And this is why. The fees make all the difference. When you see the numbers side by side, it's just wild. With an index fund, you could be paying as little as $3 a year on a $10,000 investment. Compare that to a typical active fund, you're paying over $100 every single year. It might not sound like a huge deal, but trust me, this little difference compounds into an absolute fortune over time. And here it is, the knockout punch. That little tiny, it's just 1% fee can end up costing you $65,000 over 30 years. I mean, that's a new car. It's a down payment on a house. That is real, actual money that either stays in your pocket or goes into your fund managers. But what if you could beat the market? I mean, that's the big promise, right? That's the whole seductive idea behind actively managed funds. You pay a smart expert to pick all the winners for you. And this is your classic mutual fund. You and a bunch of other people pool your money together, and you hand it over to a professional manager who takes the wheel. Their entire job, the whole reason you're paying them that higher fee, is to use all their brainpower and research to get you better returns than a boring old index fund. I mean, it sounds amazing in theory, but how does it actually play out? Yeah, not so great, it turns out. This chart is just staggering. Over a 15-year period, a whopping 90% of these expert fund managers fail to beat a simple S&P 500 index fund. Just let that sink in for a second. You're paying extra for a 9 out of 10 chance of doing worse. The evidence on this is just overwhelming. Now, mutual funds are one thing, but for the super rich, there's a whole other level of active management, a much more exclusive, high-stakes game: the hedge fund. And they have this thing called the 2 and 20 rule. It's how they charge you, and honestly, it's just brutal. They charge you a 2% management fee on your money every single year. Doesn't matter if they make money or lose money, plus they take 20% of any profits they generate. That creates a massive, massive hurdle you have to clear just to break even with the market. Let's just walk through this real quick. Imagine the market goes up 8%, and the hedge fund does a great job and matches it. Okay. First, they skim their 2% fee off the top, so you're left with 6%. Then, they take 20% of that 6% profit. At the end of the day, your actual return is only about 5.5%. Meanwhile, the person in the simple index fund who also got an 8% return, they get to keep almost all of it. The complexity is literally eating your gains. Okay, so on one hand, we have the simple, super low-cost index funds. On the other, the complex, crazy expensive active funds. That brings us to the modern kid on the block, the one that tries to be the best of both worlds, the ETF, which stands for Exchange-Traded Funds. So at heart, ETFs are a lot like index funds. They've usually got the same super low fees, the same broad diversification, because most of them just track an index. But here's the key difference, the real game changer. You can trade an ETF all day long, just like you would a share of Apple stock. A traditional index fund, you can only buy or sell it once per day after the market closes. But, and this is a huge but, that amazing flexibility can be a double-edged sword. Because it's so easy to trade an ETF, it tempts people into thinking they can time the market, jump in and out at the perfect moments. And we have decades of data that show this kind of active trading almost always leads to worse results than just buying and holding on. The ETF's greatest strength can be its biggest weakness if you're not disciplined. Okay, we've covered a ton of ground here. Index funds, mutual funds, hedge funds, ETFs. So let's pull it all together and figure out what this actually means for you, the investor. This pretty much sums it up. For the vast majority of people investing for the long term, the super low cost and beautiful simplicity of an index fund or an ETF is just impossible to beat. Sure, a mutual fund might have a place for some very specific niche strategies, but you have to go in knowing the odds are seriously stacked against you. And hedge funds? They're a playground for the ultra-rich, with fees that just don't make sense for anyone else. And that really leaves us with one final, crucial question to think about. Whenever you're looking at some new, fancy investment option, just ask yourself this. Is all this complexity really a feature designed to get me better returns? Or is it just a clever way to charge me higher fees? The answer to that question will make all the difference in the world.